Channel breakout rallies often go vertically up, and just like that, once they end, they go vertically down. That's the essence of what we have seen over the last 2 months. We've seen that the market would spend over a year in a falling channel. At one point, yes, it did look to me that it should have continued on the way down, but with all the quantitative easing, we've seen the market just turn around and rally right through. Uh, One of the lessons of what happened in this time is probably that if you keep your eyes focused on the short-term fractal of the market, then you'd eventually get to the larger picture. But if you focus only on the larger picture, you can actually miss what's happening on the immediate term, which is one of the reasons why I had to segregate the longer term picture into separate pages and focus essentially on the shorter term, on the on the day to day and week to week updates. Because I found that a lot of people get dissuaded by the bigger picture and actually miss that. Yes, it's not really possible for you to capture every top and every bottom in the market, but at some point you get an indication of what's going on, and that's probably why when the market went above 49.50, while I might have missed the lows, I think writing that we were headed to at least 56.50, 56.75 was apt at that point. Now the question is this move done, or are we headed higher to 6,000? There are a couple of indications that are showing that you could have the best maybe behind us. The two previous channel breakout rallies that I keep comparing with, one which happened in China from 2002 to 2004, and then it broke out, rallied all the way into 2007. That was a much bigger structure, and in that run ended up leading to a bubble rally. Essentially, the rally also occurs in less than a third of the time that the consolidation phase, and then once a top occurs from a channel breakout rally, wherever it tops, the fall is as vertical as the rise, and that's what you need to also keep in mind when it comes to risk management. Similarly, you saw the same thing recur in 97. In India, you had a falling channel between 96 97, and that rally retraced vertically 78% of the fall, and then when it topped with the Pokhran event, we went all the way below the previous low in a vertical fall, and again that rally took less than a third of the time that the previous channel consolidation took, and then the fall was as rapid as the rise. So that's the background in which I'm looking at this move. You had 1 year of channelized decline. You have a vertical rally. Now the target of such channelized decline is typically the size of the channel, and that's what we've not seen. The size of the channel marked up would have taken to a target of 6,000. Now we've not seen that, and which is why it's possible that this current fall is a corrective. If it's a three-wave fall, and if it finds support near 51.80, 51.50 and starts heading up again in another corrective move, we could push it all the way maybe to 5,900 or 6,000 and achieve that target. But at the same time, I think we need to wait and see whether that's really the case, simply because it's possible that this move in a failure is complete. The reason I say that is, in most sector indices I can see corrective rallies that have ended. All of them appear like three waves and have broken rising channels, so that's not nice. Two, I've seen no negative divergences in this at this recent top, and divergences typically occur in the direction of the trend. So if we were seeing a meaningful top, then we should have seen, if we were seeing, rather I should say, extensions, you should have seen some divergences if this was a larger degree counter trend action. Either that would happen in a future move, or else it simply means that this move itself was weak. So that's another risk. And then there are one major global headwind happening, which is oil. Like I've been writing again and again, that it looks like oil would be headed back to $140. There were key support and breakout levels which I identified, and all of them have held, the supports being in the 90 to 93 range. Now that level is moved up to $105, and that was the breakout point from where the target for 140 gets confirmed. So we've seen that, and I'm seeing some amount of basing in agro commodities, which are also indicating inflationary risks for more of the developed markets. And agro commodities, I mean in dollar terms. So you're clearly getting inflation in dollar term risk moving up, and that would have an impact on equities, and that would be an active risk now, I think, from here on. So that also could become a reason why it's possible that this channel breakout simply became a false breakout and failed. If you fall below 5200, you essentially go back inside the falling channel that we were in, and such a false breakout would really be bad for the markets. But like I said, because you didn't get a channel target achievement, if we do see that the current fall is only corrective, then we look for more corrective rallies to actually try and attempt making new highs. The last final factor to watch, volumes, and this was again something that was unusual. We saw the current market end without a divergence. It broke the 20 DMA. I thought last week in my note that the market would come down, but I thought it would stop near the 5350 mark, which was close to the 20 DMA in fourth wave corrective triangle. That didn't happen. It broke 5380 and is racing down to the 40-day and lower Bollinger bands as targets. Now, during this period, we've seen a continued expansion in volume from August 2011 onwards, where the market completed its B wave triangle, as I've been showing, which is the lowest point of volumes over the last 2 years. From there, volume started expanding as the markets fell. They continued to further expand as the market bounced back, and you also saw a lot of delivery volume picking up. And now, as the market has stopped last week and started falling again, you see further expansion in volume. The Nifty volume on Friday was probably the highest in several weeks, and that shows that you have continuous selling pressure throughout this move, on the way down, on the way up, and it's just growing, and that means that the buyers are just not strong enough to hold up this pressure. And unless you have an increasing number of buyers coming in now at lower levels, it's highly unlikely that this move can actually continue, because the selling pressure is just enormous. So these are key risks that I'm seeing, that some of the patterns are not normal, not like what I would have seen in previous breakouts that would have sustained a little longer, and therefore there is real risk that you've actually already topped out in the market. One of the calculations, and typically I have not found a lot of success with time calculations, but the recent Elliott fifth theorist actually points to some Fibonacci calculations between all the tops and bottoms of the last decade, and we actually hit a Fibonacci time window for the US markets this month, which is February of 2012, and if those time factors are actually to work, then this is a month where you actually see a top even for US markets. So let's see. Like I said, I've not really seen time analysis work as well as price analysis, but definitely for the Indian market, these are key risks that you've seen. Some indicators showing that most of this rise was corrective, volumes were distributive, and no negative divergences, and a potential failure in the breakout of the channel. But if the fall is corrective, if we see that the last 6 days fall ends up being corrective and turns around, then we still look for the market to attempt new highs, and I'll keep those updates coming based on the observations that show up. But these are the risks I thought that I should highlight that are existent, that could actually confirm that a top's in place, and if it does end up being a 5-wave decline from the recent highs, the next bounce back would only be another selling opportunity. That's all from me on today's update. Thanks and bye.